Hi guys, you're watching our special Made for YouTube series. I'm Sumaira Abidi, and today we are going to be shooting the first of what is our two-part series on understanding the fact sheets of debt mutual funds, right? It may also be three parts. Let's see how it goes. So basically, before we start reading and understanding the debt fact sheet of a debt mutual fund, you need to understand the components, right? So what is it that features on the fact sheet, and then we'll be able to understand what is the impact or what is the meaning when one is less or more or not there or there. So the first things first, we need to understand where mutual funds invest, and today we are going to talk about just that, which is the avenues of investment for debt mutual funds. Now, debt mutual funds naturally invest in debt, right? What is debt? Debt is a kind of loan. Right now, if you give a loan, you must get something in return, which is a kind of paper which sort of makes this promise that, you know, on so and so date, I will give you back the loan that I have taken from you, and in return, I will also be giving you XYZ% of interest, right? So that is the paper which is called by different names. Maybe it can be on the basis of the duration of the loan. It can be on the basis of who has given that loan. Therefore, by and large, the concept is the same, right? A loan is a loan is a loan. Today, what we are going to understand is that what differentiates one from the other. Okay, now the first basic comparison will be on the basis of the duration, right? So in by and large in the debt market, the loans will be either called money market loans or long-term loans, right? So money market loans are anything that has a maturity up to 1 year, okay? Long-term loans, on the other hand, are considered to be loans which are longer than 1 year, but there is no compulsion. They can also be less than a year, but money market cannot be more than a year. So money market can be less than a year, it can be up to a year, it cannot be longer than a year. Long-term loan can be less than a year, up to a year, or longer, right? Now, within these two buckets, there are a few categories of the investments that debt mutual funds make, right? Now, for everybody who has ever wondered what is the difference between commercial paper or certificate of deposit or treasury bill, they're pretty much one and the same. The only differentiation comes on the basis of the issuer. वो loan दिया किसने है, right? So a T-bill or a treasury bill is a money market loan up to 1 year given by the government or the Reserve Bank on behalf of the government. A commercial paper is nothing but that same money market loan which is given by corporates, companies. The certificate of deposit is nothing but a money market loan which is given by banks, right? So these are, what you might be hearing most commonly. There is one more which is TREPS, but I'll get to that in just a minute. So, first let's talk about these three varieties, right? And then we'll get to TREPS in a bit because, T-bills, commercial paper, CDs, these are terms that we have heard in common parlance, right? So it'll be easier for us to understand. Now, first things first, treasury bills, T-bills, they are issued by the government. Right now, the thing with money market loans is that a lot of the times you don't want to be tied into loans which have longer maturities because that's not your requirement. You just need it maybe for a few months to tide over till your planned inflow of funds comes in. You may have sent out a shipment, you're expecting money from it, or there's some sort of tax collection, etc., etc. So just like that, even the government at some point may be in need of short-term working capital, and therefore they will issue treasury bills to raise that money. Now, it's not the government, of course, it'll be the Reserve Bank doing it on behalf of the government, right? Now, if the Reserve Bank was to come and say that, you know what, I'm going to be raising XYZ amount of money for the government and, I'm going to pay you 6% for it, are you willing to give me that money? So, of course, right? Because the Reserve Bank, there is absolutely no risk of default, right? This is the sovereign that's borrowing. So, this rate of return that the Reserve Bank offers is also called the risk-free money, right? Because there is no risk and you're still getting whatever X percentage from the Reserve Bank, right? So that is one way. So a lot of mutual funds, amongst others, they invest in T-bills, treasury bills, because, it's a good way to sort of shore up some returns without having to take any sort of risk, right? So it keeps the risk down. Of course, returns are not, outstanding, but then for the amount of risks that you have taken, they'll do. Right now, what is commercial paper? Commercial paper is a similar kind of loan. The only difference being that it is issued by corporates, right? So now, if the government needs short-term working capital, a company will certainly need some amount of capital, right, to tide over till their regular money flow comes in. The only difference between commercial paper and while I explain commercial paper, let me also tell you that the certificate of deposit is the same thing, but it is issued by banks, right? So banks will give you CDs and companies will non-banks will give you CPs, commercial paper, and the government of course is T-bills. Now the difference between CP, CD and T-bills is that CPs and CDs are unsecured. Right now T-bills also it's not secured, but it is from the Reserve Bank, right? So it's as good as secure. I mean, there is no risk of default. So where commercial paper and certificate of deposit is concerned, there is that marginal risk of default, right? Now, speaking of commercial paper, this is a market that is open only for large corporates, so it's not like a small company can tomorrow come out and start issuing commercial paper. It's restricted in the sense, right? So there is some sort of credit control on commercial paper, and then the other thing is that you're only issuing it for less than a year, right? So the risk of default, now that's the other thing with the market, is that as the time gets nearer, the risk becomes lesser, right? So if you're just holding commercial paper for 3 months or 6 months, whatever, it is not considered to be very, very risky, right? Of course, in theory, the risk of default will always be there, and there have been examples in the past, but in practice that risk is quite minimal according to experts, because it is unlikely that you wouldn't come to know if a company was going to default in the next 3 months. And a lot of people say that equity market is the first place where risk is evident, and then it follows through in the debt market, right? So debt market still has that sort of headroom to see whether there are any shocks that a company is seeing in the equity market, right? If your share price is suddenly crashing, then you have to go back. If you're holding debt of that company, you have to go back and take a call on it, right? So it's not that you will be caught entirely unawares, but yes, you have to be vigilant. The other thing is that over here again, credit criteria becomes very, very pertinent, because the thing is that you are raising money, right? So you're raising money at a rate of interest, and you will get a better rate of interest only if you have a better credit rating. So that's the other thing which works in this market. It's not very pertinent for us, but yes, if you see the scheme that you're invested in is earning a very, very high yield from commercial paper, you will have to go back and check, because it probably means that they're lending to companies with a lower credit rating, right? That's why those companies are willing to give a higher rate of interest, right? If I'm a company that's rated AA or B, I go out in the market and people tell me, we can't lend to you because your rating is not good enough. But they go to, suppose I'm a mutual fund manager, and they come to me and they say, you know what, I need money. Instead of the 8% that everybody is giving you, I'm willing to give you 10%, right? So if that is the case, it's something to be wary of. It's something you need to be vigilant of. So if you suddenly see a spike in yields in your fund, you need to see whether or not they're taking exaggerated risks by lending to companies with lower credit ratings. Okay. The other thing that we spoke about, of course, certificate of deposit. Now, this is issued by banks. And again, over here, in theory, yes, there is the probability that a bank can default. But in reality, it's, the probability is almost negligible, because, a banking failure is a catastrophic event, right? It will have its effect in many fields and sectors, and it'll be a very, very big deal. And of course, in India, the Reserve Bank has been very, very active in ensuring that there are lots of checks and balances, and therefore one assumes that this is relatively safer. Now let's come to the fourth part of this money market loans, which is called TREPS. Now, I know it sounds, a little scary and confusing, but it is really not so, right? So first, what is TREPS? TREPS is nothing but the tri-party repo. Okay. Now, first we have to understand, for those who may not know, a lot of you watching would probably know what is repo, because everybody who has ever seen a monetary policy knows that the Reserve Bank gives out the repo rate. Okay, so anyway, let me, without digressing, quickly get to the heart of it. So repo is basically nothing but the rate at which banks will borrow from the Reserve Bank, right? Now, this repo, suppose, for as an example, if I was to use, is 4%, right? Now, there is a certain percentage of money that banks, and this is only banks that we're talking about, right? Banks can borrow from the RBI. Now, when they exhaust the repo window and they're still in need of funds, they will ask for additional funds from the Reserve Bank. So the Reserve Bank says, you know what, I gave you X amount of money at 4%, which is the repo rate. Now I'll give you X plus, whatever, 10 money at the MSF rate, marginal standing facility, because you have exceeded the repo window, right? So instead of 4, it'll be whatever, 4.55. Now, banks get that money, right? And this is all overnight money, because a banker cannot go home till they have tallied the books, right? So sometimes, because you have so many thousands and lakhs of transactions going on in a day, and plus you have so many branches where transactions are happening now, of course, ATMs, digital, that there might be some mismatch in terms of the tally, right? So you will take an overnight facility from the Reserve Bank, tally your books, and then go home. And then, of course, tomorrow it becomes a news story again. So now it's not just the banks, right? Every NBFC, insurance company, mutual fund, any other corporate, they might be in need of these overnight funds too, right? But they can't approach the Reserve Bank. So what they did was that they got the Clearing Corporation of India to make a similar platform, which was called the TREPS platform, or the tri-party repo. Now, over here, they'll all go and register themselves. If I'm in need of overnight money, I'm just going to go and see who are the people who are available to give me that money, and I will borrow it for the overnight. Now, a mutual fund, and this is a number which can be in the mutual fund fact sheet, can be either negative or positive, because either you're giving or you're taking, right? So if you're taking money, and why would you do it? You do it sometimes to honor redemption requests. If you get redemption requests more than the cash that you're holding, you don't want to sell the asset in your books, right? So you'll be like, you know what, tomorrow I'm going to get inflows again. Just for today, let me take some money from the TREPS market, pay out the investors who want to redeem, and tomorrow, when I get fresh money from the new investors, or I get the SIP money, I'm going to pay out this TREPS, and I'll be back to having matched all my accounts, and in turn I've also not sold any assets. So this is one reason, right? So in this case, TREPS in the fact sheet will show as a negative figure, but it may also be that I have cash in my books. I have cash in my scheme, and cash is not earning anything, so I will put it to use in the TREPS market. I will give out the money in the TREPS market to another person who may be in need, and this is the case when it will show up as a positive figure, right? So when you're tracking your debt mutual fund fact sheet for TREPS, you have to see whether it's a negative number or a positive number, and now you know what both of them mean. Now, negative number also per se is nothing frightening, right? It is a normal course of business for a debt mutual fund. When you need to be worried is when it exceeds. So the SEBI will allow a debt mutual fund to borrow up to 20% of its assets from the market, right, for issues like this. So the reason why you need to get up and take notice and check is when you see the TREPS portion or the cash borrowings reaching that 15%, 18%, 20% mark, and if they want to go above 20%, they have to take permission from SBI. And we saw that in the Franklin case, that in some funds it was as high as 37%. So those are the times to be worried. Anything less than 15% would be a normal course of business. If you see 12, 13, 14% consistently, you might want to, check up on it, but not to be unduly worried, right? So this is basically what TREPS is. Earlier there used to be this thing called CBLO, that's not used anymore. So it's by and large TREPS that you will be seeing, which shows up in your debt mutual fund fact sheet. Okay, now let's talk about the long-term sources of investments for debt mutual funds. Right now, long-term, again, there are four. FD, which is a fixed deposit of a bank. There is corporate security of debentures, which are issued by companies. There is bonds, which like we spoke about, could be government, state government, companies, and there is something called a pass-through certificate. Now, I'm going to just quickly go over what these are, because I want to spend some time on bonds and pass-through certificates, because that is where a lot of the confusion happens, right? So bank fixed deposit, I don't think there's anybody watching this who doesn't know what it is or how it works. So, I'm going to let that pass. The only thing to note though is, if you have ever, invested in a bank FD, then you would know that it can be 3 months, 6 months, right? So that's a perfect example to show that a long-term loan could be less than a year or longer than a year, right? But all money market loans, remember, will always be less than a year. Okay, so and even the corporate security debentures, it's pretty easy to understand, they're issued by the companies. And the other thing is that, within these there are several categories, right? So I'm not going to go into the subcategories today. Perhaps at a later date, once we have made the second video about understanding the fact sheet, then we can go into more details. But for now, just suffice to say that it is one avenue of investment. Now, the two I want to focus on is bonds, and bonds also primarily because I want to speak about this term called the yield to maturity, which a lot of investors are getting confused about. What's a coupon rate, what's the yield, how does it work? So bonds are basically, again, long-term loans which are taken by pretty much anyone, which can be a government, center, state, or it can be any sort of company. Right now, the first thing when you're issuing a bond, and you don't issue one bond, right? So you say, I'm going to come out with a bond issuance, right? So suppose I'm a company, I say I'm coming out with a bond issuance of 1,000 crores, right? Now 1,000 crores, I may ask 3 people, right? Any one person may not be able to give me the 1,000 crores. So I'll say, what? I'm going to break up this issuance into bonds which have face value of 10 rupees each, right? Or 100 rupees each, whatever it is. Now, for ease of understanding and for my calculation, let's assume that the face value is 100, right? So this means that I have come out with 10 bonds, right? Which I can place with different people. Now, if somebody was to give me money against the bond that I have issued, I need to give them something, right? That's the interest that I will be paying on that bond, and that interest is called the coupon rate, right? Now, the face value is what is the value of each bond at the time that I have issued it. The coupon rate is the rate of interest that I promise to pay the person who is giving me the money. Right, so those are the two terms as of now. Now, what happens with bonds is that, in pretty much every way, they are like a bank FD, right? The only difference is that bonds can be listed on the exchanges, they can be traded. There is a secondary market for bonds. FDs, no, if it's in your name, it remains in your name, right? So bonds can be traded, right? And therefore, the price will go up and down. And of course, the government 10-year bond is considered to be the benchmark bond, right? Everything else is benchmarked to that. So when these bonds trade, the price will go up and down, right? So now suppose if the bond that I had, which had a face value of 100, once it's trading in the exchange, it goes up in value and becomes 110. Right? Now what will happen is that, suppose the life of this bond is say 5 years, right? Now, if I continue holding it for 5 years, now I have bought it from the market for 110, right? But the face value of the bond is 100. Now I have to hold it for 5 years and during those 5 years, I will be getting paid a rate of interest of 6%, right? When this bond matures after 5 years, first of all, I will get my 100 rupees back, right? The 10 rupees extra which I paid to acquire it in the secondary market will be my capital loss. Right? Let me explain it once again. एक कंपनी ने बॉन्ड इश्यूएंस किया जिसमें फेस वैल्यू जो थी बॉन्ड की, मतलब ईच बॉन्ड का जो प्राइस था वो 100 रुपये था, राइट? उस बॉन्ड पे वो कंपनी कहती है कि अगर आप मुझे पैसे देंगे तो मैं आपको इस पे 6% के हिसाब से इंटरेस्ट दूंगी। ये बॉन्ड अब सेकेंडरी मार्केट में ट्रेड होने लगा, तो इस बॉन्ड की वैल्यू सेकेंडरी मार्केट में बढ़ भी सकती है, घट भी सकती है। अगर इसकी वैल्यू सपोज बढ़ी 110 रुपये हो गई, तो अब जो मैं ओरिजिनल बायर थी, मैंने 100 रुपये पे ख़रीदा, अब मुझे अगले इंसान को बेचना है 110 रुपये पे, तो मुझे लग रहा है कि यार इसकी जो मैच्योरिटी है 5 साल की है, 5 साल के बाद मुझे 100 रुपये वापस मिलेंगे जो उसकी फेस वैल्यू थी, और मुझे हर साल 6% के हिसाब से इंटरेस्ट मिल रहा है। बट अभी आज के आज एक बंदा खड़ा हुआ है जो मुझे कहता है कि तुम मुझे अपना ये बॉन्ड बेच दो, मैं तुम्हें 110 रुपये दूंगा, तो मुझे आज के आज 10 रुपये का मुनाफा हो रहा है। सो आई डिसाइड कि ठीक है, चलो मैं तुम्हें बेच देती हूँ, ठीक है। सो आई अर्न 10 रुपीज़ एक्स्ट्रा, दैट इज़ माई कैपिटल गेन, राइट? नाउ आई एम आउट ऑफ द पिक्चर। अब वो जो दूसरा इंसान है जिसने 110 रुपये पे ख़रीदा है बॉन्ड, वो उसको तो कैपिटल लॉस आज की तारीख में हो गया 10 रुपये का, क्योंकि 100 रुपये का बॉन्ड है, तो जब मैच्योरिटी होगी तो उसे तो 100 रुपये ही मिलेंगे, और बाकी जो भी इंटरेस्ट कूपन रेट जो है 6% के हिसाब से वो उसे मिलता रहेगा हर साल। तो इसकी फिर यील्ड क्या हुई? सो यील्ड इज़ नथिंग बट व्हेन यू सो on a 100 rupee bond, you were getting 6%, right? What is that 6% on a bond which you have bought for 110 rupees? Because अगले बंदे ने तो वो बॉन्ड 110 रुपये में ख़रीदा है, राइट? तो उसका जो रिटर्न होगा, इफेक्टिव रिटर्न, वो 6% से कम होगा, क्योंकि 6% या 6% जो है वो 100 रुपये के बॉन्ड पे है, राइट? सो ही विल गेट मार्जिनली लोअर, whatever, 5.5, 5.6. मेरी मैथ्स थोड़ी कमज़ोर है, so ignore the numbers, but I hope you get the drift of what I'm saying. That is called the yield, and the yield to maturity is the effective return that he will be earning till that bond matures. ये चीज़ दूसरी तरफ भी हो सकती है कि आपकी जो सेकेंडरी मार्केट में, मेरा जो 100 रुपये का बॉन्ड था वो सेकेंडरी मार्केट में फ़िलहाल 90 रुपये पे ट्रेड कर रहा है, लेकिन मुझे पैसे की बहुत सख्त ज़रूरत है। मैं कहती हूँ कि ठीक है, मैं अभी 10 रुपये का कैपिटल लॉस सह लूँगी, लेकिन मुझे 90 रुपये आज के आज चाहिए। तो दूसरा एक आता है, वो कहता है ठीक है, मैं आपको 90 रुपये देने को तैयार हूँ, मैं आपसे बॉन्ड ख़रीद लेता हूँ। नाउ आई हैव सफर्ड अ कैपिटल लॉस of 10 rupees, I sell my bond to the other person, I am out of the picture. That other person has bought it at 90, so first of all that 10 rupees when the bond matures will be his capital gain. The 6% interest, the coupon rate, he will keep earning it at the periodicity mentioned. Now what will happen to his yield? His yield will go high because जो 100 रुपये की चीज़ थी उसने 90 रुपये में ख़रीदी है। So when you calculate the interest on something which person A has bought for 100 and person B has bought for 90, naturally the person B is getting a better rate out of it, right? That is his yield. And yield to maturity is basically the yield that he will be earning if he holds that bond to its logical maturity or its natural maturity, which will be 5 years. So I hope I have not caused further confusion, and in turn I hope that this concept of what is a bond, what is the coupon rate, what is the yield, what is the yield to maturity, I hope I have been able to make this clear. So basically, if the bond price goes up, your yield will go down, and if the bond price goes down, your yield will go up. Okay, so this is a concept that I hope I have been able to understand. So this is basically how bonds work, right? So the final thing today is a pass-through certificate, right? Now, what is a pass-through certificate? If you open debt fact sheets, you'll find it to be used, on and off quite regularly. Now, basically, companies are trying to raise money, right, all the time. But I may be a company that, I may not, suppose I'm giving out loans, right? All my loans are not created equal. Some loans will be paying back money on time, their EMIs on time. Some people will not be giving me the money that they owe me on time, right? So those are the loans that I will start classifying as non-performing assets. Now, most of it is a mix, right? Now, if by and large the people who are returning money or your good assets are in a majority, things are fine, right? But what happens is that if this ratio becomes imbalanced according to the rating agencies, they will start giving you a lower rating. Now, if you get a lower rating, you're going to find it more difficult to raise money, right? Because everybody wants to give to a AAA company. Not to say that all AAA companies, have no risk of default. We have seen AAA companies fail, but nevertheless, the probability of default is less, right? So you want to give your money to a AAA company, and yet there are people, AAA companies are saying, I have no requirement to borrow. If you want to earn a rate of interest, give it to a AA company or below, whatever. So now these guys, what they do is they don't want to borrow money at a higher rate of interest. I don't want to have to pay 9% or 10% when AAA companies are paying 8%. So what do? So I carve out part of my good assets into a special purpose vehicle, right? Now I go to people and say, you know what, while my entire universe of loans may be rated AA, I have given you a portion of some of my best loans, and give me a good rate of interest now. So this is basically it's called the process is called securitization, and this is how they're able to raise money at a relatively competitive rate. They'll still not get the AAA rate, but yes, much better than what they were earlier getting. And why does it work for mutual funds? Well, one, because you have in many cases the liberty to craft out that pool. You can say that I want a certain demographic, I want a certain age profile, I want people who have repaid loans within the first 5 days or whatever. So you can actually craft it to your requirements, and therefore you will be like, okay, if a AAA company is able to get a loan at 8%, fine, I'm ready to give it to you at 8.5% or 9%, marginally higher, and the other company is happy, because otherwise he's paying 9% or 10%, right? Here he's at least getting some advantage. So this will show in the debt fact sheet as a pass-through certificate. Now this it can be a dicey thing. You have to speak to your advisor if you see either a very large allocation to a PTC, or you see very frequent appearance of PTCs in your fact sheets. You might want to take a look, because the risk of default remains, right? I may be paying my EMI for the first 6 months. In the 7th month, I may lose my job and not pay, right? So the risk of default is there. The other thing is the risk of illiquidity. Not a lot of people are buying securitized portfolios, right? So I may buy something and say that, you pay me 8.5%, but then I may be stuck with it for 5 years. I have nobody else to sell it to, right? So, those kind of risks remain, and therefore, PTC, pass-through certificate, is something that you have to also monitor very, very closely. Well, there are, quite a few more things that I wish to have covered, but we're out of time. I think we've already spent quite a lot. So we're gonna make the next video, and probably the next 2 videos, it seems like, and then we'll try to understand what are the other abbreviations, what are the other terms that are mentioned in the fact sheets, and then finally, how do you read a fact sheet? What does it mean? And the other thing is that, for those who don't know, the fact sheet is basically, it's a 1-page snapshot of everything that's happening in your scheme, and it comes to you monthly. If you're already an investor, you will be getting it monthly via email. If you're not an investor, you can go to the website of any of the debt mutual funds that you wish to track, and you can see it on their website. And this is not something that you monitor once you're already invested. Yes, of course, if you're invested, you better be monitoring it, but you better see the fact sheet of the last 2-3 months as well if you're planning to make investments. I hope this has been helpful to some degree, and do share your feedback. I look forward to hearing all that you have to say. Thanks very much for watching.